Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. It is often thought that a business that makes a profit is successful, and one that makes a loss is not. Whilst there is a great deal of truth in this statement, it has to be remembered that profit is only an indicator of how successful a business has been over the period over which that profit was calculated, in most cases a year. However, if you want to identify a business's accumulated financial strength over a number of years, you have to calculate how much it is worth today, which this presentation will do by exploring statements of financial position. So what are we going to learn in this presentation? Well, first of all, we're going to find out what a statement of financial position is, and then we're going to explore why organisations prepare statements of financial position. Okay, let's get started by asking, what is a statement of financial position? A statement of financial position is a document that calculates how much a business is worth on a specific day in time. In really simple terms, a business does this by comparing its assets, the things it owns, such as property, equipment and cash in the bank, against its liabilities, the money it is due to others, such as a bank loan or cash due to suppliers. As such, if a business had assets worth £200 and liabilities valued at £50, then its business worth would be calculated at £150. £200 of assets minus £50 of liabilities. This, of course, can then all be pulled together to create the top half of a statement of financial position, as shown. However, although what we have done so far has allowed us to work out what a business is worth, it has failed to answer an important question, which is, how was that wealth created? In other words, how were the business's assets financed? As you might expect, the answer to this is found out by discovering how much money the owners of the business have injected into it, plus any profits retained in the business over previous years. Now, I know many of you will be asking, what about the money a business has borrowed to help finance the business, such as a bank loan? Surely that helped create wealth. Whilst this is a valid question, you have to remember that this borrowing has already been included in the top half of the statement of financial position as a liability, as it is money that has to be paid back to others. Okay, so that now leaves us in a position to complete the bottom half of the statement of financial position by including the owner's equity and retained profits, which, as can be seen, also comes to £150, as both halves of the document must balance. Now, although our description of the different parts of a statement of financial position are accurate, it would be fair to say that in reality the document would be rather more detailed. It is therefore important that we should look at each part in a little more detail by first looking at assets. There are two main types of asset that a business can own. The first, called non-current assets, are assets which have a long lifespan and change in value infrequently, such as property, equipment and vehicles. The second type of asset, however, called current assets, are different in nature, in that they change in value frequently and have a short lifespan. For example, current assets a business may have would include cash, inventory, and money due from customers who have not yet paid, referred to as trade receivables. Okay, let's now move on to look at the two main types of liability by first asking, what is a current liability? This type of liability refers to financial obligations that are payable within the next year and which change in value frequently. Such liabilities include items such as a bank overdraft, or suppliers the business has yet to pay, called trade payables. This, of course, leaves us with our last type of liability, called non-current liabilities, which are financial obligations due over a longer period than a year and which change in value infrequently. The main non-current liabilities a business may have include a bank loan, a commercial mortgage, or debentures. Okay, so pulling this all together, and what you have is a statement of financial position as shown, but which, for simplicity and clarity, has excluded individually listed items under each heading, such as property and vehicles, which would have been under non-current assets. Right, let's now move on to our second question and ask, why do organisations prepare statements of financial position? As we stated at the beginning of this topic, one of the main reasons why an organisation prepares a statement of financial position is to identify how much the business is worth, and hence is a good indicator of its financial strength. For example, if year on year a business's net worth is increasing, it suggests a strong and growing business that has enough assets to cover its liabilities. However, if the opposite is true, it indicates a business that is struggling, as its liabilities are eating into its assets, which erodes the value of the business. Following on from this, another reason is that by looking at the different elements of a statement of financial position, a business can pinpoint where it is strong and where it has issues. For example, if a business's current assets are greater than their current liabilities, this would be a good indicator that the business has enough readily available cash to meet its immediate debts as they fall due. Of course, this type of analysis can be even more useful if figures are compared from year to year to identify trends. For example, if a business's non-current liabilities are rising year on year, this suggests a business is taking on more debt, which, if interest rates were to rise, could become very expensive to repay. Of course, this type of information can also be useful in other ways, in that it can support effective decision making. This is because if this business required additional finance, it may look to raise it from shareholders rather than taking out an additional bank loan and adding to its already high non-current liabilities. However, as well as the internal reasons discussed, some organisations, for example companies, must prepare a statement of financial position for external reasons as well. This is because by law a company must create and make available to the tax authorities and the general public their statement of financial position. Further still, should an organisation wish to obtain funding from a bank, it will also be asked for its statement of financial position. This is because a bank will want to identify how financially strong the business is and what assets it might be able to provide as security for any lending it offered. Okay, so what did we learn in this presentation? Well, first of all, we found out what a statement of financial position is, and then we went on to explore why organisations prepare statements of financial position. Calculating how much profit a business has made using an income statement and how much a business is worth using a statement of financial position are two incredibly important aspects of sound financial management. It is absolutely vital that a business knows and understands its financial information so that it can support and improve its future decision making.